Hey everyone, welcome back. The following is a breakdown on macroeconomics and things like interest rates, as well as, importantly, how it impacts the stock market and trading. You've probably seen in the last few weeks things like Powell, the chairman of the Fed, coming out, announcing new interest rates, seeing major changes in the markets. So I could tell you, as an industry professional for nearly 2 decades, macroeconomics and understanding them are critical to your trading strategy. We're going to go through that and have a full, robust breakdown, which I think will be very valuable to your trading. And the following is taken from a Twitter live space. Enjoy. We'll get started in just a moment here, but I'd like to begin by saying every live space is recorded and will be reposted in case you'd like to come back, revisit any utility you get from that, to listen again and maybe to absorb things differently. And of course, also so that you can scrutinize. I think anything I say, if you're a serious person, you should be able to stand by your word, for better or for worse, put it on the record, and allow for people to come back and listen. So I make sure all of my live spaces are recorded. I never delete my tweets, sort of thing. There's none of that. And I will say something in advance. There's no hindsight called it. So with that said, the topic here is going to be understanding macroeconomics. And of course, this isn't going to be a comprehensive discussion on all things macroeconomics. There are, university programs for that. That's what I took in university. And we can go really, really deep. But one of the things I said is that I guarantee you don't need an economics degree to understand enough information to reap benefits as a trader or investor. And one of the things, one of the clear signs to me that people don't understand, or that you're dealing with a fake guru, is there's never any talk about market conditions. You'll hear someone say, the market went down because we lost level XYZ. That's when you're trading. Technical analysis is important, but no, the market doesn't. That's not why. You happen to lose XYZ as the market went down. Of course, as the market goes down, it'll cross a lot of different prices. But there are underlying catalysts, real world events. There are actual reasons that we have bull runs and we have bear sessions, right? So like the last one, when we had a drop around the pandemic, we didn't have a drop because we lost a specific level. We had a drop because there was a global pandemic, and there was a tremendous amount of fear and concern. So investors were selling off, understandably. So it's one thing to note. And when you don't see someone speaking about that, that's not a serious person who understands the market well. Obviously, or they would discuss market conditions. It's just another one of the 1,000,001 calls and puts, just calling things out and trying to market themselves. So it's important for you to understand as a trader. And I'd like to get into some of the things that impact the markets, maybe talk a little bit about the Feds, and help you guys get a better gauge on where we stand right now. So let's get started. Start with the obvious. So we have the money supply that was injected into the system. Most of you have probably heard about quantitative easing. So that's money essentially. And I'm just going to speak in a way that, just to be clear here, I don't like to speak for myself. I like to speak so that I can be helpful to an audience. I'm not here to try and make myself feel like I'm some sort of intellectual or great person by being overly verbose. I want to speak plainly so that everybody can understand. And I think that the hallmark of a good, intelligent speaker is one that can connect with their audience, as opposed to one that speaks for their own purposes. So I'll break it down in such terms. For those of you who understand on a deeper, more sophisticated level, that's great. But we'll go, this again is an overview. It's not going to be a 40-hour economic lecture. So when we talk about quantitative easing, there's money being injected into the system. So why would money be injected into the system, or printed, whichever way you want to look at it? That is to support the market as a whole. We'll say the market is synonymous with the economy. So when I talk about the markets, just know that this is synonymous with the economy, and they're somewhat interchangeable. Now, that's to prop things up. You feel that it's appropriate to provide a catalyst. And essentially what the Feds do, when you hear about the whole thing of like the Feds and Powell, and what do they really do? What is their role? Their role is to attempt to manage the economy. Now, we've always had sort of the external force that is the Feds to adjust the economy. And the actions that they take have a significant impact. So things like injecting cash into the market or printing money, that is going to prop up the economy. That gives more opportunity, puts more money into the system. When rates are low, interest rates, that means that money is cheap. That's one way to think of it. So, for example, if you were going to borrow $100,000 and you had a 1% interest rate, that means annually you would pay $1,000 in interest. That means money is pretty cheap, right? So you may turn and be confident to make investments for yourself, for your business as an investor. Maybe let's just take a scenario where you borrow money and then you go invest it in the stock market because you're confident that you can get a 4 or 5% return, right? We're not being aggressive. This isn't for the talk of you're going to get 5,000%, bro, overnight. Did it? Let's go. No, particularly when you're dealing with large sums of money, it becomes more and more difficult to manage. So you can understand this from the perspective of an institution, because these are the big players, the whales, if you will, that drive the markets, right? So when we see a big mutual fund make a move, they'll change the price of a large cap stock. Whereas you or even me, like if I took everything I had in my private equity and we dumped it into Apple, let's say I just bought Apple ruthlessly and I hit the ask, you know, you might see a slight change on a 1 minute candle and that's it. And it would just disappear. It would be like throwing a brick in the ocean, right? Maybe if you're zoomed in, you'd notice something, but it's insignificant. But who does shake the market are large institutions who hold multi-billion-dollar positions or multi-million-dollar positions. So when interest rates are low, you can borrow and be more aggressive with your money because what you're facing is almost free money. Let's say it's a 1% interest rate. That's next to free money. What do I mean by free money? Well, no, you don't get to keep all $100,000. You have to pay it back, but it's almost free on an annual basis in terms of the return that you're paying. So as the Feds hike up rates, right, it becomes more expensive. Now you have to reconsider. If you're thinking you can get a 5% ROI on your $100,000, well, what happens when it goes to 4% interest rates? Now, what you're looking at is that's only going to be a 1% return because you're going to pay, all else equal on when you time it and such, you're going to pay 4% and you're targeting 5% return. Now your risk is higher, right? Because now you're looking at it thinking, okay, if I hit my target, I come out ahead 1%. And if I don't, right, if I'm flat, I lose 4%. So money is less attractive. So you might not put it into the market, right? You might just say, now's not a good time to get aggressive with my investing because money is expensive. Or perhaps if you're a business, you might also look at it and say, now's not an aggressive time because the market is going to be pulling back, right? There's less spending because remember, what impacts businesses also impacts your everyday people. When the rates go up, if you have a variable rate mortgage, your mortgage goes up significantly, right? And it doesn't sound like a lot, but you think of a family that was paying, let's say in January, $2,000 on the mortgage, that's now paying, let's say, $2,350. That's significant for people, particularly after tax, right? And as the market continues to grow, and it's hard to project. Not only that, sort of the compounding factor here and what shrinks the market as rates go up, why we start thinking bear market, recession, that sort of thing, is you also start to see companies pull back. So if you're just an average American, what happened is things are more expensive. And typically when you see rates going up, it's because inflation is aggressive. So your groceries, your gas, and everything else are more expensive. And your variable rate mortgage just went up significantly. You're a few $100s per month out of pocket. That's significant after tax. Now, on top of that, you have a higher chance of losing your job. Not saying everybody's going to get fired, but during a recession, that's when you tend to see across the board cutbacks. First, it works as companies go flat, they stop hiring, right? And then they start laying off, right? And that's because they're not as profitable. It's not a growth period. Sales aren't as high. Things tend to struggle. And of course, we have some recession-proof securities and some cyclicals will do better in a recession, but that's by virtue of simply being more safe. So it's not necessarily that, your staples like Procter and Gamble do better necessarily. It's they do better relative to other stocks and they are safer. So that's the way it works as the Feds tighten rates. That's why I see the markets start to come down because there's less money. These companies are getting less money from consumers because consumers are tightening their belts. These companies can't borrow money as easily. It's more expensive to borrow money. So you can see how the Fed rates impact everybody. Now, another side that I want to touch on, and again, like I said, we're going to make today simple. is when we look at the supply side. And that has to be considered because what we just talked about is focused on demand, right? Let's say we just looked at houses just to underscore this point. You're going to see less demand for purchasing houses. The real estate market tends to cool off, and you're already seeing that. I think in March, we saw the lowest number of new mortgage applications. We're seeing mortgage applications fall. You're seeing new builds go on hold. That's because rates are going up. So if you're planning on buying a house and you were thinking, okay, I'm going to pay 2% interest, let's say, or 3% interest, let's say that was a year or so ago, it wasn't quite 3%, and it varies per person. But let's just say it was 3%. You're saying, okay, I can afford that. So this is going to be a $400,000 house. That means I'm going to pay $12,000 a year in interest. Plus I need to service my mortgage. Okay, well, if that went to 5%, you now went from 12,000 to 20,000 in interest. Huge difference, right? Because remember, you're paying it on everything that you borrow. So demand comes down as those rates go up. You guys can understand. Like, you're not going to buy as much stuff if things cost more. Does it make sense? I think it makes sense to everybody. So then we have to also look at the supply side, because that's one thing that I think the Feds are underestimating right now with the way that they're managing things. And we'll get to how you can trade around this and prosper in this market. So on the supply side, that's something we also have to be cautious of, right? Because that impacts the market as well, and that can drive the market down, and that can be problematic. So when you see supplies tightening, that also drives prices up, right? And the Fed's solution to rising prices is to gradually ease up interest rates, which is proven to be effective. Although I disagree with slow playing it, I also disagree with the way the Feds are sort of, I don't want to say gaslighting, but sending the markets in every which direction, which I'll talk about in a minute. But when we talk about supply, when you hear things like supply shocks, so Russia is not exporting wheat, and we just heard that India has said they're concerned about a food shortage, so they're not exporting wheat either. And there's gasoline shortages or fuel shortages in oil because of Russia coming down. So what does that do? Well, it's economics, right? It's a simple economics. And I said we make this simple: supply and demand, right? If you have more demand, things go up. Just like we had in the past few years, where money is free, people are getting free checks, they're getting incentivized to stay home from work. There's all kinds of grants going out, there's checks going to people's homes, interest rates are super low. Okay, so there's tons of money in the system. People consume more, they buy more. Demand is higher, that shoots price up. That's what creates inflationary pressures. Well, what else creates inflationary pressures? When supply is short, right? Like, a simple way to think of this for anybody just trying to equate it into everyday thinking is, if something is rare, you tend to pay more for it. If something is abundant, you pay less for it. Very simple thought on this would be a collectible, right? If there's a baseball card or a painting, if it's a one of a kind, all else equal, it's going to be a lot more expensive than if there were 50,000 of them. Well, this is also the case in economics. And as we see, as these supplies become less, and I'm not just talking about the supply chain, but the actual production of items and exporting. So I'll differentiate. When we talk about the supply chain, that is a big issue, and I think there's just gross incompetence everywhere there. But it's not just a matter of saying, oh, supply chain, supply chain. I hear a lot of gurus say that. I hear a lot of people repeat that. And again, you can always spot the fakers because they just try to repeat what they heard, because their priority is to sound like they know what they're talking about. So they repeat what they heard, but they don't understand it. It's not just the supply chain. If there's nothing being produced or exported, it doesn't matter how many tankers you have in the water or how many trucks you have on the roads. They're not carrying anything. If there is no wheat to import because we can't get it produced, right? We don't have enough here. It's not being produced for us, or it's not being exported. It doesn't matter how many tankers you send over to India or how many ships. They're not sending anything out. Same thing with oil and other commodities and resources. If they're just not there, it's not about simply a supply chain. So as supplies tighten up around the globe, what's going to happen is that creates an additional inflationary pressure. And so then you have to look at the impact. So when you see oil prices going up, that is an inflationary pressure, right? And then if you look at what that does to the average person, how many things rely on petroleum products, that's a big deal, because it's not just, this is what you have to understand with the economic situations. it's not so simple like as to listen to your Furu friend or the Jim Cramer, just someone who oversimplifies it and dummies it because they either don't understand or maybe, you're talking head on CNBC who does understand, not just CNBC, all the markets. They know better, but they just want to be sensational. When you think about this product, it's not just a matter of saying, okay, well, my gas is going to be more expensive. No, you have to think of the overall context when you're thinking of macroeconomics and market conditions. Because, okay, yes, you'll pay more to fill up your tank if oil is more expensive, but you'll pay more for everything. Why? Well, how do you think all your products get to the stores? How do you think Amazon gets their products? They get them driven in trucks. How does Amazon get it to you? They drive them out in vans. How do things get to your grocery store? In trucks. What do trucks use? Gasoline. What does gasoline cost? More now. So their costs are higher, right? So the transport costs are higher. So then the costs are higher on the shelves. So everything goes up because of petroleum costs. So when your oil is going up, it's not just a matter of saying, oh, whatever, I don't mind paying $5 more for a tank. It sucks, but I'm not too mad. No, you're going to pay more for everything that requires being transported to you. So essentially, the exception of digital goods, and we could talk about the cost of electricity and energy, everything goes up. And that's the same thing. When you think of, okay, wheat's not being exported, be like, I'm keto anyways. Maybe you're on a ketogenic diet. Everything that involves wheat, all the byproducts of wheat become more scarce and become more expensive. And so then that creates an inflationary pressure. And so what's the Fed response to inflation? Well, they now have to increase rates to decrease demand because that's their approach. Well, we'll just increase rates more and more aggressively. So that's what's happening now. And I think a lot of people are overlooking it. And that's why I've looked at the economic data. And I don't see anything positive in the sense that this is the bottom, it's the time to buy. If we do turn around, I'm always happy to let other people find the bottom first, because out of 100 people who try to time the bottom, 99 get torched, one guesses right. I'd rather see a reversal, see changes in the economic data. How do I use this? Well, right now we're seeing erratic market conditions, and this will touch on what the Fed's doing. I said I was going to talk about that. What I think they're doing wrong and horribly is part of their duty, unfortunately, and I don't think it should be because I'm a very stick to business kind of person, is to not only attempt to manage the macro economy, but they've taken on the role of trying to manage expectations and temperaments of the market. So meaning if Powell says something too honest or forward, right, says what he probably thinks, like if he comes out today and says, it seems like we are inevitably heading for a recession, right? What's going to happen? The markets are going to absolutely tank. And the way that it works in the markets is it does have a bit of a domino effect. So perhaps it would be substantiated for let's just say a 5% pullback on that statement. Well, what you end up getting is maybe a 15% pullback and the markets would have to freeze. Why? Because as you see someone pull back really quickly, it starts hitting your stop loss, or you go into panic mode as a trader and you dump off. And then when you dump off, and I mean this on a gross scale, and the other person beside you dumps off, the price goes even lower. So then the next person who was holding off saying, okay, I'm going to hold off till the QQQ hits 300. Now they freak out because it's at 299 and they sell off. And then a ton of other people are holding off, sell off, and then chain reacts. So now it's not only correcting for the news, it's panic selling. And of course, it's understandable. Like if you were thinking, hey, I can hold through some of the panic, I won't sell till we get to 290, and you just see the market start flushing down quickly, you're going to feel a bit of panic. You're going to feel a bit of concern. If it doesn't hit your stop loss, you're going to manually exit, right? So part of what they do is they try to manage temperaments. Now, I don't like that because it creates, I want to say it's not forthright. I'm not going to say dishonest. It is a little dishonest, but we'll say it's not forthright. I don't want to freak my lawyer out and get a call after this about watching my words. It's not forward, right? So they're trying to manage temperament, and I don't think that they should really have a national role as market psychologists. But I do understand their position in saying we're going to bring this along slowly. For example, transient inflation, right? Inflation is transient. It's transitory. Everybody knew that it wasn't. I was saying that it wasn't for a long time. Okay, granted, I've been in the markets for a couple decades as a professional trader come 2005 and option specialist, study economics. You could say, hey, you should have known it. Sure. But if I should have, they should have as well. Powell is
very well established, very intelligent person, right? So he knows more about the markets than I do. This is specialty. He has better insight. I think he knew that it wasn't transitory, or knew that there was an extremely high likelihood it would not be transitory. But this is the way that they manage everybody. So when you're hearing that, you need to apply your own insight and recognize that sometimes messages will be put out to manage the markets. The other thing that is problematic is they create the volatility that they're against. So you've been recently hearing them condemn the markets and say, oh, it's turned into a casino. The volatility is unhealthy. This is really bad. Retailers are doing this. And, the blame is being put on meme stock traders, all that sort of thing. Well, I'll tell you what sends the markets up and down. When on one corner, from one corner of your mouth, you say, the economy is strong. We're not even considering the 75-point basis hike. And on the right side of your mouth, you say, but also inflation is way too high. We need to be aggressive. And there's probably a lot of pain ahead. Those are completely opposite positions to take. And this is silly because then what do you see? You see the market spike and the markets drop, and then the markets rise and drop. So one of the things that you look at is you try to look at conviction. So this comes to how we position trades with options. When you're looking at unusual whales, for example, consider what happened during the day. So when you're looking back, if there were calls and then we moved up 10 points, those calls have likely been exercised and satisfied. And the opposite is true of put positions. And if you don't know unusual whales and you're interested, of course, check out my bio. There's a discount code, but get familiar with it first. Don't jump into anything without being familiar and comfortable. And so this is what happens. You need to understand there's a lot of hedging going on. And hedging, as you know, is a safety play. So why do you take a safety play? Well, you take a safety play, if you will, when markets are erratic and you have a difficult time predicting where they're going and you want to protect yourself. So a lot of the data that you see, I see different people copying what I say. I say mixed data all the time, but I explain what it means. And I'm happy if I'm educating some of the followers. At least it'll be good information that they give out. What I'm saying is that it's mixed. It's hard to interpret, right? Because I can recognize there's a lot of hedging going on, and there's other things that I may have some insight to just through my private equity work and working with specific colleagues where we all share knowledge and data. But to simplify it for everybody, that's part of what happens is you're more prone to hedge in times where there's erratic movement. Like when you're coming to the market saying, hey, our position could move up or down today far more than we expected, what you'll do is you'll mitigate risk. And that's what it's called, risk mitigation. Every institution, and I can tell you because I've worked for institutions, has entire teams dedicated to risk mitigation, risk management. So you're protecting against risk, and one of the ways to do that is through options purchases. So sometimes what you're seeing isn't necessarily a signal. And what I say is there's more noise than there is signal. So you see a lot of data, but it's not a clear indication and it's not a signal. It's more noise. So I try to be conscious of that. And that's why on some of these days I'm saying, hey, we have fewer plays, fewer trades. You're seeing us calling out on some days I've called out 4 or 5, but recently it's slowed down to 1 or 2. I don't have a quota, as I say. I will only call out what I'm convicted to is where I see clear data. That's another thing. When you see these furus who magically somehow have 5 call outs a day, that's not how the market works. You take the opportunities that are there. For those with 401ks underlying who are buying stocks or who are trading, I can't give you specific advice, but one thing that I think is a very good idea is to monitor macroeconomic conditions. If you look as far back as January, it was January 12th, I stated officially on my Twitter page, and I've brought it up a few times, and I've reiterated. It wasn't like a one-off and then I hide away. If I say something, I will repeat it and reiterate so as to update my position and stand by my words. I said I was scaling out of all growth positions and advising clients to do the same. As I saw a bear market on the horizon, I was no longer comfortable. It's time to move out. And of course, we've tanked since then. I've repeated that position multiple times. I think that it's important when you have a lot of your holdings tied up, particularly people in the 401k. I can't provide specific financial advice. These are just trade ideas and education. But I think it is a very good idea to be conscious of the market cycle and where we're at, because this is your 401k, this is your livelihood. The Fed doesn't care about you. No one else is going to care about your money as much as you will. No person on Twitter, no talking head on any television show, because they're going to be okay. Like they're all going to make a lot of money. Same with every politician. They'll get paid. They'll get paid a lot when we're in a bear market, when we're in a bull market, if the economy and housing crashes, if you're underwater with your mortgage and your house, they don't care. No one will ever mention you. So this is why I'm big on the idea of I try to help as many people as I can. Be conscious of where we are economically, right? A stock isn't cheap just because the price is lower, right? If you look historically, I know that a lot of people haven't traded before 2008. If you look at the last bear market, a lot of people coming into that market had that same approach of thinking, there's no way this is going to go down. This is a killer stock because they'd only known strength in certain names. They'd only seen those names go up. And the thought of this staple blue chip $120 stock ever going down to $70, that was absurd because they'd done technical analysis, they'd watched their levels, they'd done fundamentals, and they thought, no. I've never seen it dip this far. But yeah, it does. And this is what happens in downturns in the economy is that things scale back and they can scale back pretty significantly. And a good benchmark for everyone, this is simple. I'm not even talking about a major economic crash. Look at where we were pre-pandemic and where we are now. It shouldn't be unfathomable to think that we might return to those levels or lower. You can't, that's not a trade idea. So again, I'm just trying to caution people with, carving out some of my time out to just get everybody to think, tune out the noise of the talking heads screaming, buy the dip, this is cheap. Well, ask why. Why is it cheap? Isn't this sort of what happens during a market like this? What makes it cheap? If a company is underperforming and there's a drop in price, that's not cheap. It means they're underperforming. If something loses value, you naturally pay less for it. And actually, if it has a trajectory downwards and it's losing value continually and the conditions are getting worse, I wouldn't think now is a good time. I'd think this is on the wrong road. I'm going to wait to see where it ends up. So hopefully that gives everybody a little bit of insight on how to strategize, what to look at when you're looking at options, how to hedge your positions, and just be careful and what to consider, for your 401k, your retirements, your funds for yourself and your family. Just be protected and forearmed with knowledge. That's what's going on. Listen out to what the Feds are doing. What I heard today was, oh, we're in a good position, but, we're probably going to be aggressive. Inflation is too high. And if inflation's too high, we already talked about it, their response will be to more aggressively raise rates. And remember, what sparked a bit of a rally was in the last Fed meeting, they came out and said, oh, 75-point basis hike is off the table. And we think we may have seen the inflation may have peaked, right? It was all positive terms that sent the market up. And one thing I mentioned is inflation peaking doesn't mean that it's coming down. It could be stabilizing at a very high rate. And even if it's coming down, it could stabilize and not continue to come down unless the Feds aggressively move it down through rate hikes, right? So there's a lot there to be considered. And just forearm yourself with this knowledge. I hope this helps you. You could pass it along to your families, friends. I really cheer for Team Retail. Hope the best for everybody, and we can do one of these again. Have a great evening, everybody. I really hope that was informative, and we will talk soon.